Imagine this for a moment. You open a stock market app like Robinhood or Fidelity. You type the name of a company like Apple. You see a number on the screen, maybe $190. Now ask yourself a simple but powerful question. Who decided this price? Why is Apple 190 and not 19 or 1,900? Why does the price change every second, even when the company offices are closed? And how can millions of people all over the world agree on one single price at the same time? Most beginners think stock prices are set by the company, or by Wall Street banks, or by the government. Some even believe it is all random or manipulated. But the real answer is much more logical, much more human, and once you understand it, the stock market starts to make real sense. In this video, you will learn what actually moves stock prices, why prices go up and down daily, and how long-term investors look at prices very differently from traders. By the end, you will never look at a stock price the same way again. Before we go deeper, let me tell you exactly what this channel is about. Welcome to Crypto Brain Power. This channel is dedicated to teaching beginners how the stock market works, learning from market history, understanding how markets evolved over time, and building long-term wealth step by step. Everything is explained in a simple, practical, and educational way, especially for people who feel the stock market is confusing or risky. Now let's get into the heart of the topic. How are stocks actually priced? At the most basic level, stock prices are determined by supply and demand. This is the same concept that decides the price of anything in real life. If more people want to buy something than sell it, the price goes up. If more people want to sell than buy, the price goes down. Stocks work exactly the same way. When you see a stock price on the screen, that price is simply the last price at which a buyer and a seller agreed to make a trade. Nothing more, nothing less. If someone is willing to buy Apple at $190 and someone else is willing to sell it at $190, a trade happens and that becomes the market price. But this leads to a deeper question. Why do people want to buy or sell at certain prices? This is where expectations come in. People don't buy stocks based on today alone. They buy based on what they believe will happen in the future. Let's take Apple as an example. Investors ask questions like, will Apple sell more iPhones next year? Will its services business grow? Will profits increase? If people believe Apple will earn more money in the future, they are willing to pay a higher price today. If they believe growth will slow down, they may only want to buy at a lower price, or they may sell what they already own. This is why news matters so much in the stock market. When Apple reports strong earnings, the stock price often jumps. When a company like Tesla misses earnings or gives weak future guidance, the price can fall sharply. The market is constantly adjusting prices based on new information. Another important factor in stock pricing is company earnings. Over the long term, stock prices tend to follow profits. A company that consistently grows its earnings usually sees its stock price rise over time. Amazon is a good example. For many years, Amazon reinvested profits and focused on growth. As investors became confident in its long-term earnings power, the stock price increased dramatically. Beginners often focus only on the stock price itself, but price alone means nothing. A stock priced at $10 is not cheaper than a stock priced at $1,000. What matters is valuation. Valuation asks whether the company is expensive or cheap compared to its earnings, growth, and future potential. This is why metrics like the price-to-earnings ratio exist. If two companies earn the same profit, but one stock trades at a much higher price relative to earnings, it may be considered more expensive. However, even valuation depends on expectations. A fast-growing company often trades at a higher valuation because investors expect strong future growth. Stock prices are also influenced by the overall market environment. When interest rates are low, stocks often become more attractive because investors are not earning much from bonds or savings accounts. When the Federal Reserve raises interest rates, borrowing becomes more expensive, and future profits are discounted more heavily. This can cause stock prices to fall, even if companies are still performing well. This is why events like Federal Reserve meetings, CPI inflation data, and the U.S. jobs report can move markets. If inflation is higher than expected, investors may fear higher interest rates. If job growth is strong, it can signal economic strength but also raise concerns about inflation. Stock prices react not just to the data but to how that data changes expectations. Market emotions also play a huge role in pricing, especially in the short term. Fear and greed can push prices far above or below what fundamentals suggest. During market crashes, people panic and sell at any price. During bull markets, people chase stocks higher because they are afraid of missing out. The GameStop situation in 2021 is a perfect example of this. The stock price was not moving based on company performance alone. It was driven by supply, demand, short squeezes, and emotional trading. This shows that in the short term, stock prices can behave irrationally. But over the long term, fundamentals usually take control again. One common beginner mistake is assuming that daily price movements reflect the true value of a company. In reality, daily moves often reflect noise, news reactions, or emotional trading. Long-term investors focus more on business quality, earnings growth, and competitive advantage than on short-term price swings. Another mistake is thinking that a falling stock price automatically means a bad company. Sometimes great companies see their stock prices fall due to market-wide fear, economic slowdowns, or temporary issues. This is why experienced investors look at the business, not just the chart. For beginners, a simple way to think about stock pricing is this. In the short term, stock prices are like a voting machine. They reflect opinions, emotions, and headlines. In the long term, they are like a weighing machine. They reflect earnings, growth, and real business performance. If you are investing through platforms like Charles Schwab, Fidelity, or Robinhood, it's important to remember that the price you see is just the current market agreement, not a guarantee of future value. Prices can go up, go down, or stay flat for long periods. The most practical lesson here is to avoid trying to predict short-term price movements. Instead, focus on understanding businesses, diversifying through indexes like the S&P 500 and thinking in years, not days. Long-term wealth in the stock market is usually built through patience, discipline, and continuous learning, not through guessing price moves. So the next time you see a stock price flashing on your screen, remember this. That number is simply the result of millions of people expressing their expectations about the future. It is not magic. It is not random. And it is not guaranteed. If this video helped you understand the stock market a little better, subscribe to Crypto Brainpower for more simple and educational videos about investing, market history, and long-term wealth building. This video is only for educational purpose. Educational purpose only, not financial advice.